Alright, so now continuing with the next part. A low point. Where was I? So observe how the rally begins in the second and running to the fourth, and the fifth is accomplished on low volume. So obviously he was talking about the fourth and the fifth and all of this, low volume, etc. I covered this in the last video. Alright, it is accomplished on and all of this, so we covered all of this. Okay, so anyway, I'll go over some of this again. Observe how the rally from the second to the fourth, so you have the second to the fourth is on low volume, showing that whatever demand exists in the expectancy of a recovery from the former lows is not willing to, from the support level, is not willing to follow prices up. So low volume pullback here means that low volume rally, or the pullback to the, relatively speaking, to the decline, is on low volume, which means that the buyers are not willing to follow prices higher. Such support is most likely due to short covering, so you have that one bar wonder, which is your short covering. The rally, which begins May 7th, lasts only 3 days until the 9th, and that day's closes around the low, which shows that the bulls have exhausted their power. Okay, where is that? That is around here. I think it's around 5, 6, 7th, right there. Okay. From the 11th, the downward march of prices is resumed, and the volume increases on the downside, showing a break of fresh liquidation. Alright. Okay, so this is your fresh liquidation right here, increasing volume. As prices going down, it's increasing. And lows compared this section. Okay. A low point is recording around the 13th of June. What? Oh, on June 2nd, not the 13th. So you have your liquidation, right? Keeps going down, lower low, lower low, lower low, inside bar, lower low, lower low, lower low. Alright, good. So all of this, more liquidation. Okay, a low point is recorded around 113 on June 2nd, and the close practically at the low. With the close practically at the low. The only warning, so let's take a look at the warning. Remember, the prior warning here came with heavy volume on lack of a shortening of the downward thrust from bar low to bar low to bar low. Let's see what warning is over here. The only warning the average gave us of upturn from this point was a small downward progress made on June 2nd in comparison with the previous day. Yeah, I mean, that's barely a warning. But what he's saying is that from here, the break, you see this heavy break from low to low, there's a big move, right? What happens afterwards? Low to low, very little. So that's the only warning, and that's kind of difficult because I mean, that's just one indication, but I think the other one is the key, and that's the heavy volume from low to low. You see? Let's go over here. You see, from low to low, initially brought out this much volume. Okay, look at the progress from low to low. From the next low to low, you have more volume, but look at the progress from low to low and close to close. So the progress from low to low and close to close was very little, relatively speaking, and the volume was very high. It was higher than before, the bar before. The close price on January 1st was 114.5, and on the second 113. Alright, this showed resistance, possible buying by substantial interest. Moreover, the market has now been declining steadily since the high point, where the average has recorded 173. The price 113 is therefore 60 points down, which means the prices have shrunk to about 1/3 from the high. Whatever. The point here is this: SOT on heavy volume. Okay, that's that. Oh shit. Okay, that's what's really important. What the hell is this bar? I don't know. Okay, so where is right there and right there. What does that mean? That means when you're looking at a chart and price is going low, 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 or high, 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 observe the volume and see how much progress is resulting from it. If you see high volume, but the low to low is very little, you have to question why. Or if you see high volume and the high to high is very little, you have to ask yourself why. Why isn't it able to go higher? What is all that buying? What is all that volume? What is it? Is it selling? Or is the other side showing resistance? In this case, support. Like, this is the key indication from low to low. Heavy volume. What's that telling you? I can't go any lower. That's what it's telling you. Even with all this volume. Why? Because someone's holding the bag. Someone's not letting... As it goes down, someone's saying, okay, I'll buy it. So you have to ask yourself, what is happening to this volume? What is this volume? Why can't it push prices lower when it's the biggest volume on 1, 2, 3, 4, 5, 6, 7, 8, 9, 10? Like why can't it go lower? That is, I think, is the questions. And that is the same thing that happened here, where you had this, which was a break. Then you had this, and then you have expanding volume. So you had to be able to observe these two, which is pretty high, relatively speaking. If you had like a volume moving average, it would definitely be above it. But I think this is much more clearer. Why? Because it's a big volume on 1, 2, 3, 4. It's the biggest volume in like 14. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 1, 2, 4, 5. It's like over 20 bars. And no progress. So some may call that effort, whatever you call it. You have to... It's like you're judging volume relative to price progress. And determining who's stronger, the buyers or the sellers. Or at least determining if you're encountering resistance or support. Anyway. Next is the charts of leading stocks. Okay, but for the purpose, we're just using the trend chart. He was saying, okay, during this time he was looking at the wave chart and daily leading stocks, etc. But right now we're only using this information. We're judging the market by its own action and not other wave charts and leading stocks. Alright, but that's what I will be doing later, is using the wave and the and leading stocks, but we'll see. Wave chart. For the purpose of this explanation, we're only going to use this chart. We will assume that this is our only guide. So when the market suddenly reverses its form on June 3rd, recovers 9 points in the average and closes nearly at the top, with a volume of trading equal to that of about 2 previous days of heavy liquidation, we must, somewhere during the session on June 3rd, cover our shorts if we are still short. So look at his logic here. When the market suddenly reverses its form on June 3rd and recovers, in the average, recovers 9 points in the average and closes nearly at the top, which means a high-end close, with volume of trading equal to that of the 2 previous days of heavy liquidation, we must somewhere during that session cover our shorts if we are short. In the event this should be done at the next day's open. Alright, so he's saying you got heavy volume, heavy volume, and then this is your change of behavior. So this is climactic volume, and that's your change of behavior. He's ready to cover. The question is, what about here? Like, would you be ready to cover here? Why here and not here? So this is like, this is a question, right? So I don't really see the reasoning, but because the same indications here, heavy volume and possible change of behavior right here is there, but on that bar you know that there's something wrong. Okay, here you have extremely heavy volume and you have a bar. Now on this bar here, I think it's game over. Why? It's the follow through. And look at the widespread, big range, and decent volume. And now you have a full rally. So for me, it's like more about getting out on this pullback, on any pullback, because of the additional indications here. So anyway. The averages have shown no preparation for a change in trend. He's saying there's no preparation in terms of a base. This sudden change is like a hypodermic or heart stimulant administered to a patient who is dying. He suddenly revives. Of course, we all know that this change reflects the favorable sentiment to news. Okay, but these things do not always show on the chart at the time they occur, and we cannot consider them. Okay, so his main important point here is that news matters, and news is not on the chart. We are learning to read the market without the aid of newspapers. Having operated on the short side for the past 3 months, we have substantial profits even though we cover at the high prices of June 3rd or around the opening of the 4th. We wait developments in order to ascertain whether this bullish factor is sufficient to turn the tide. That is, turn the bear market into a bull market. With sufficient experience as the foundation for our judgment, we know that this violent change in trend occurs within a few hours, are not lasting basis for bull operations. Alright, so here's what we know. We know that this here is news. Okay, the second thing we know, you have SOT on high volume that caused the reversal, but we also know that there's no preparation. No cause or prep. The close at the top, June 3rd itself, indicates a further rally. On the 4th, there's a gain of nearly 5 points, making about 14 points below. The volume is still high. Alright. Additional reasons for taking such actions are that the pace of the decline on the 27th and the 1st became so sharply accelerated. This is important. This is the difference between this and this. The difference between this and this is acceleration of price and volume, which is known as hypodermics. that right there, right there. Like if you draw a this is not that sharp. The one on over here, up here is not that sharp, but over here the angle of descent is very, very steep. Okay, so that combined with excessive volume is telling me, all right, you gotta get out. And this right here, I'm not sure if he mentions this anywhere. Okay, anyway, sharp accelerated as to create an oversold condition which is dangerous to shorts, and speed with which the market recovers to later day loss suggests the phase of the downward movement is probably in the nature of a shakeout. Well, whatever. This is climactic volume and a change of behavior. He doesn't say that, but I know it because this probably is the biggest volume on any up bar since. Yeah, I'm gonna put a change of behavior. So. Alright, that right there is a change of behavior and news, but there's no cause of preparation, and that right there is climactic ball. Right there. I mean, some people might call it effort reward, but whatever. It means the volume is climactic here, and that reverses. I bet that's the biggest volume on a reaction since somewhere around here. That's heavy. So I'll add it. And it's even though he may not have put it there, it's according to the same logic that he used earlier in the chart study. So why not put it there? Anyway, so this is a shakeout. I think that's what he's saying. Is we have good progress on high volume, but on the 5th, the gain in the average is only 3 points, and the volume decreases a little, showing that the buying power is less. Okay, buyers are reluctant to follow prices after such a steep rise. The close price is below that of the previous day, which indicates the day's net pressure of supply stock was greater than the demand. I don't know what he's saying here. But on the 5th, 3rd, 4th, 5th, right there is the down, low close, red bar. But on the 5th, the gain in the average is only 3 points, and the volume decreases a little, showing that the buying power is less. Buyers are reluctant to follow prices after such a steep rise. The close price is below that of the previous day, which indicates the net pressure of supply stocks was greater than the demand. So the close, up or down, that's what he's looking at, and heavy volume. So on the 6th, there is a further loss of nearly 8 points, bringing the average down halfway from the top. A normal reaction on reduced volume. After a small recession, the average runs up and closes at the top, showing that the market met support at the 120 line. 120. It met support right there. It recovers to 125 right there, which is about 2/3 of the reaction. Okay. Although volume is comparatively light, the speed of the rebound and the behavior describes says the balance is in favor of the bulls. This is the first time you have something that talks about a low volume rally. Now you have a favorable background. That's the first thing. Okay. Alright. Now a lot of times what you hear is when you see a rally and you're like, oh, it's a low volume rally, it's bearish. No, demand already proved itself with a high volume rally in the background. So now you have a low volume rally, and it doesn't mean it's bearish because supply needs to prove itself. Demand already did that in the prior rally. The speed of the rebound and the behavior says that it's in the favor of the bulls. So this is the first time you hear about low volume rally, but other factors countering it and saying that it is bullish. And this is why you can't use indicators, because if you program low volume rally equals bearish, it's always going to be bearish because it's following a rule. But here the low volume rally is still bullish because the background it's able to read has high volume. Now if you do an indicator, it has to consider all of this. Oh, if it's a low volume rally, but what about supply? Okay, what about the background? Is there a high volume? It's just so many variants that it's going to miss a lot. Anyway, all right, and notice it's a low volume rally, not a low volume pullback. That is a very, very key distinction. From the 8 to the 15, a zone is established thoroughly, roughly between 130 and 120. Okay, let's see how it works out. A zone is established. Okay. As the days progress, we see we observe fall in volume, which is not a bullish sign. Okay, so initially it was low volume, and that was okay, but as the days progress and the zone is established, then the volume tapers off. So again, there's judgment required in this. It's very, very difficult to just markets can't use rules, that's for sure. The zone is established. Okay, now there's dullness here. Alright, narrow ranges. You can really see the tightening. The range is narrowing right up there. That's a bearish sign. This bearish symptom is confirmed by the 15th by a little wider spread from high to low, meaning more activity. Wider spread meaning more activity. A close near the low and increasing volume showing slight increase in pressure. I think he's looking at this bar right there. More activity on the downside. Okay, so that bar was the concerning bar for him. Was right. Okay, that bar, right, I forgot which one was it. I think that was it right there. And then it pulls back. Now the pullback here is on low volume. Note that. Okay. Which is different than the rally being on low volume, which is different than the rally continuing on low volume and being in a tight zone where it's meeting a former high and that resistance. And meets support. Low volume pullback. Okay, now let's go back down here. Here we have a variation of the sequence of a selling climax, technical rally, and a secondary reaction. Consider the action in the broad perspective. Observe that the volume diminishes appreciably on the secondary reaction to June 19th, even more decisively than the case of the secondary reaction on December 29th, and in marked contrast with increasing volume on the secondary reaction, which failed to hold. Also, the market on June 19 meets support well above the climax lows. Likewise, compare the greater speed, spread, and sustaining power of the June 3rd to 6th rebound with that of the April rebound. Okay, all I know is this is a low volume pullback. Okay, you have low volume pullback and you have climax and change of behavior bar and you have a rally. Why? This rally had followed through and this is your pullback. Alright, so that's what he's saying, but just, you have your climax, you had a rally, and you had a pullback. Alright, so this is a higher low. Oh shit. So you have a low volume pullback, it's a higher low, and you have strength in the background and all the action of termination here. Okay, so that's what he's really saying. Next day on June 20th removes all doubts as to the immediate tendency of the average for the market opens up a point and a half above the previous night's close. So this is what removes all doubt. That is a progress. Going into new high ground above the prior trading zone, meaning above resistance. The heavy volume emphasizes the importance of this. The gain in the average over the previous day's high is more than 7 points and the close is near the top. If we have been watching the tape during the day or refer to a wave chart at the end of the day, we observe this sudden change and we either buy during the session with a close, a stop, or we wait until the price breaks through its former high. Okay. And buy, so he's ready to buy over here after it breaks. Now, if you were watching the intraday wave chart, and if you're looking at the daily, you're probably not, but if you're watching the intraday day chart, you notice the higher low and all that strength. Try to get in on it, but if you're watching the daily, this is the breakout on heavy volume. Buy around, buy. You are long right there. Okay. Long entry right there on the breakout. Nothing wrong with that. or it takes out the range long. Although the close is near the top, the volume has fallen to about, what? I'm on the wrong. Where am I? Okay, I lost my position. 1 second. Alright, so you're buying the close over there in the breakout of the day's open of the following session. Basically, you're buying the close. Okay. As the market's behavior here tells us that we may expect a quick markup, we are not justified in reestablishing investment positions, however, for as explained, we do not have the basis for a lasting advance. So this is really important. There is no preparation. There is no preparation. There is no cause. June 22nd, there is a high opening and a gain of 7 points in the average, most of which held for the day. The volume runs up to 4.6 million. The price is gaining in proportion with the rising volume. A reaction on the 23rd shows that most of the gain of the previous day was lost, but the bullish indication therein is a shrinkage of volume to about 2.6 million shares, nearly half the activity of the day before. This is a warning sign. Alright. So you have high volume, boom, 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 and right there it's shrinking. So June 22nd, there was a higher opening and a gain of 7 points. Right. The volume runs up. The price is gaining. A reaction on the 23rd. Reaction on the 23rd shows most of the gain of the previous day was lost, but the bullish indication therein is a shrinkage of volume, nearly 1/2. I think he's talking about this. The 24th recovers the loss. The average advance is 8 points for the day and 3.5 points above the June 22nd, or to 141, and the volume is the highest. Okay, we begin to grow wary of the bull side because the volume in comparison with the trading of the previous week indicates selling by large interests. So he's just worried about the high volume up here because it's climactic and the expansion is pretty significant, and relative to the prior weeks it's way too high, all the way up there. We move our stops with a point or so and wait a development. The 26 makes further progress about 2 points in the average. Closing a point from the low on big volume, large supply overcoming an excited public demand coming in, as usual on the top of the rise. This is distinctively bearish. So again, you got the same thing. You have a climax followed by a bar that's red. We therefore close our long positions and examine our individual charts that are in weak technical positions to go short in the next bulge. June 26th shows a range of about 5 points, a little narrower. Although the close is near the top, the volume has fallen off, and and the up thrust are shortening. This is not like a regular up thrust. It means like thrust to thrust, meaning the high to high are shortening. Okay, in the net, these indications are bearish. So again, what are indications that you have? You have excessively high volume here. You have a red bar right after. This is climactic. And here you do have like another high on lessening volume. And now you have another high, but the volume is dipping. This shows like the actual movement today in the market. You have certain, you might the market, even though you have ending action or whatever, sometimes it continues until it doesn't, and it reverses. Okay, so that's what he's talking about here. Like this is more realistic, because a lot of times you'll have high volume, but it's coming from here, from a consolidation, and it's not at the top of a trend. Okay, like here you had a not top of a trend, but top of a swing. So here you have very excited public, and you have a breakout, they're in, but right here it's telling you, okay, something's wrong, because this is very high volume. This is probably the biggest reactionary volume since the low. And then you have 2 days high on decreasing volume and decreasing shortening of the thrust. So let's add that, right? So, I mean, putting all the net indications that he's putting together, and sometimes it's really not that clear. So over here you have a high volume, and it's kind of like a breakout or continuation. Then followed by that, you don't have follow through. Instead, you have a reversal red bar that's on very high volume, and I think that's the key indication, because that high volume on that red bar is probably the biggest since the low, and it's very high, like relatively speaking to the entire trend. That, in my mind, that is really important, because as soon as it got there, someone started selling. The other thing is, you're in this range over here. Okay, so there must be folks that are trapped here. So you're over there. It goes up, and finally it reverses. There is a lower volume, and maybe the buying pressure is abating up here. Maybe that's what's going on, and it is on top of a swing, like from here to here. But it's not that easy to say, the market, it's terminated. You just see low volume after that high volume reactionary bar. That may make the case that something's wrong. So he says the net indications are bearish. Volume has dipped, and the thrusts are shortening. This outlines a new trading zone having been established between 137 and 143. By saying trading zone, he means trading range. On the 27th, the average bulges over a point, narrows its range to 3.5 points, and closes with a net gain of about 1.5 points on a volume of about 3.8 million. This looks like bidding up to a new high in order to catch shorts, and selling on the way down. We therefore put out some shorts. This is another technique, bidding up to a new high. Like there is something to be said about that. When they bid up to new high after selling is in the background, they bid up prices to a new high in order to catch shorts and trap longs. So this technique, I think he comes back to it a couple of times later on. It's going to be made more clearer. On the 29th, the open is lower and the price recedes. Okay, I think I'm gonna stop right here. We've covered from here to up here. So